My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job is not just to entertain you, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Look, people, we're losing some themes, and that's causing trouble for this market. Even as the averages were basically flat today. Dow dipping 65 points, S&P inching up 0.23%, and the Nasdaq advancing 0.34%. It's narrow. Unless more companies and more sectors start doing better, you aren't going to get the kind of healthy breadth that so many investors want to see before they dive in. Now, we've had a terrific market for most of the year, but many, if not most of the people I talk to, believe the rally is unsustainable. They think we'll have to pull back unless things broaden out. Now, we know the rally is driven by a handful of stocks: NVIDIA, Apple, Microsoft, Alphabet, Amazon, Oracle, and now Broadcom, which we own from a Chapel Trust. We put out a bulletin to all club members that told the tale. Broadcom's equipment is integral to generative AI. It makes much of the plumbing that goes into the data center. It has many other tech businesses, including a very big telco division that's been in the doldrums for ages. But Broadcom's incredibly strong artificial intelligence revenue, $3.1 billion, up from $2.3 billion the previous quarter, totally outshone anything negative. As we told members of the club, its AI-related business saw a continued surge in sales. Management raising its full-year outlook to $11 billion, backing up our view that this is one of the best AI chip stocks in the market. And that's how this $770 billion company that you may never heard of could jump more than 12% today. Oh, that and the 10-for-1 stock split that's designed to make the stock more enticing to home gamers hasn't even happened yet, and it's already working. So, as usual, there was the pin action from a major tech company that reported a good number. NVIDIA rallies 3.5%, Dell up 2.4%, Arista up 6.5%. Third happened to be Broadcom's partner, Micron up 1.7%. Tech might continue to lead tomorrow as Adobe, which is on later in the show, reported a stellar quarter. This is that graphics company that does actually so much more than graphics. It gave you an excellent forecast. Like Broadcom last night, this stock is soaring in after hours trading. We can have an exact repeat of what happened today. Bears and tepid bulls dislike that this market's led by a handful of tech stocks. Look, I don't blame them. I prefer to see many more sectors participating. Sure, that would be great. The problem is that they often can't participate because of issues in their sectors that make it difficult for you to own their stocks without the potential to lose a lot more money than you do if you own tech. So let me take down some of these issues so you know what I'm talking about and have a better idea why we are not broadening out, and then make a decision whether you want to be in tech. Because of the issues that I'm talking about, you might not want to be in the others. Let's start with the banks. This group, a bellwether sector for the market, had been producing some really solid gains ever since we realized the Fed was done raising interest rates last fall. We got solid beat and raise numbers when they reported their first quarter results. But this week, the winning streak ended, and it ended in a very strange way, an unnerving way, frankly. Huntington Bancshares, HBAM, one of the best regional banks, cut its forecast because of what's known as lower net interest income, or NII. This was totally out of the blue, people. Just this week, Huntington's CFO traveled with UBS to Europe and told a really compelling story. Earlier this week, the same CFO went to a sector conference and said net interest income guidance would come up short, projecting it to be down 1% to 4%. Previously, it was supposed to be flat, maybe somewhere between plus or minus 2. Now, that may not sound that much to you, but when you think everything's fine, you get gaffe like that, you start thinking, Huntington, it can't possibly just be Huntington, right? Who else is to cut numbers? Someone else is lurking. That's why investors collectively decide to sell the banks first and ask questions later. Why take the risk with the averages at such high levels? Now, I personally think Huntington will prove to be an aberration, but it doesn't matter what I think personally. What matters is that stock, which was about $14.25 a month ago, is now at $12.34. That's a roughly 13% decline. So for the moment, nobody wants to go near the banks for fear that they'll have a Huntington on their hands. Second, healthcare had been a reliable group until very recently when it started rolling over. Once again, I like the stocks down here. We're doing a week-long series of the most attractive growers in pharma. They're what you should be buying in a slowdown where inflation is going lower. That could fit our description of our market. But last week, we got a very strong employment number, robust hiring. So we don't know the direction of the economy overall. Without any degree of certainty and no call from the Fed saying the slowdown is imminent, the recession-resistant healthcare stocks have been getting hammered. I think you should buy the weakness. I already recommended AstraZeneca, Merck, and Novartis earlier this week. I got another one later tonight that has a good dividend, still one more tomorrow. Now, I like these kinds of stocks, and more important, I like to buy them when they're going lower, not higher. But again, sadly, that's not what most people like to do. They like to chase. I don't like to chase, but most people do. Third, there's the transports. Now, this is a fulcrum group that does have me concerned because the transports are trading like the economy might have a much more abrupt slowdown than we, especially me, are thinking. Now, some of these names have underperformed for quite a bit. United Parcel, for example, seen the stock fall 14% for the year, with a precipitous drop in the last month, 150 to 134 and change. That, to me, is worrisome. Trucking giant J.B. Hunt. It's down 20% for the year, thanks to multiple points of weakness when it last reported. Intermodal down 9%, contract services off 2%, integrated capacity solutions off 26%, truckload, where revenues declined 13%, operating income had a 75% nosedive. That is terrible. How about the ugly action in the rails all of a sudden? This normally robust group has been smacked down hard. CSX and Norfolk Southern down 6%, Union Pacific off 9% for the year. These are relentless, grinding downward moves, and they don't seem like they're stopping anytime soon. When you compare that to Apple or Broadcom or Adobe, I mean, geesh. Fourth, we witnessed a sudden precipitous decline in the food and beverage group. The very reliable Molson Coors symbol TAP has gotten clobbered, falling over 17% for the year. It just dropped from $69 in April to $50 and change. Today, hitting a 52-week low today. Kraft Heinz is down 12% for the year, back yielding 5%. PepsiCo, which is not known as a wild trader, right? It's gone from 183 a month ago to 163 today. I mean, that's just unnerving. Oh, and obviously there are stocks like McDonald's, which has fallen from 302 in January to 253 and change today, just 8 points up from its low in October of last year before the Fed's big pivot. It joins the likes of Starbucks, which is off over 14% and for the year and can't seem to get any traction. The restaurant cohort has been very disappointing, aside from some extremely positive exceptions, Chipotle, Wingstop, Domino's. Today, the bears even got to aerospace as GE got smacked, declining more than 3%, thanks to a number cut from J.P. Morgan related to supply chain issues. Boeing was thrown back for a 1% loss, but Boeing always seems to be thrown for a loss. Problem is, I'm not cherry-picking here, people. Those are the largest sectors in decline. I could have widened my net to include oil and gas, retail, non-pharma healthcare, drugstores, entertainment. These are all very weak sectors, but weaker for reasons that are understood. Numbers are either bad or starting to roll over. Their stocks cannot hold these levels if numbers are being cut. Lots of landmines. So understand, it's not that the market needs to broaden out. It's that buyers can't. They're afraid to go. The buyers are afraid to broaden out. It's too risky. Too much uncertainty away from tech. Too much certainty in tech because of the coalescence of accelerated computing and generative AI. Because of what Jensen Huang has told us. He's the CEO of NVIDIA. Here's the bottom line. Ask yourself, without the AI-related tech names, where would we be? But more important, if you sat them out because you waited for the rails to catch fire or the foods to catch fire or the banks, well, you've missed out on some major gains, and that's our job, is to find them. Sometimes you just have to accept that it's worth trying to make money in a market that has some really bad breath and no mouthwash in sight. Let's go to Bill in Massachusetts, please. Bill.
Booyah, Jim. How are you today?
I am good, Bill. How are you doing?
Can I just take 30 seconds and talk about the club, Jeff Marks, the morning meeting, and you?
Sure, that'd be nice. You know, I didn't put you up to it. I'm thrilled that you mentioned it. Thank you.
It's all me. I wanted to give a special shout out to Jeff Marks. He's coming into his own. He keeps you grounded in the meetings. I love how you guys bounce things off each other. Today's meeting was great.
Well, thank you. That is what
coming into his own.
Bill, thank you. Jeff and I sit next to each other, and what you see is what we try to do for the club. The whole day we're doing that, back and forth, including for Broadcom, which we had and was terrific, but for Starbucks, which we had and was miserable. So we go over the good and the bad. Now, how can I help you now?
Well, Jim, I've been doing my homework on this company. I feel very bullish on American Express. Please give me your opinion.
I like American Express very much. I was sad to see it downgraded the other day. I don't think it should be. I think Steve Squeery's doing a terrific job. The stock's 22 points off its high. That makes a lot of sense to me. I know the chart looks terrible. I think that's driving a lot of the downward momentum. I think you buy some and then you wait 10. And I'm going to tell Jeff's watching the show, and I know you're going to make him feel great because he is great. He's just a terrific partner. Anyway, look, sometimes you just have to accept that it's worth it to try to make money in one particular group, even if there isn't participation away. We must always be opportunistic, people. If you've been sitting out the big tech names in hopes for a broader rally, then you've missed some of once-in-a-lifetime gains. Well, man, by the time Signet Jewelers reported light sales, sending the stock lower. But could an uptick in engagements be an opportunity to get in on this name? I'm chatting with the CEO, and it's really a forecast that's lighter. I thought the quarter was pretty good. Then I'm continuing my series on healthcare stocks by seeing if Pfizer could be poised for a comeback after its pandemic peak. And later, I'm checking in with Adobe CEO to hear where the software stock stands in the competitive digital design space that I think they dominate. It's after a big earnings beat. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.